Look, uh, if you are still trading your finite time for money in an AI economy, you're not just falling behind, you're being actively replaced.
Right, you're trading hours for heavily taxed money, while the wealthy are trading capital for automated leverage. I mean, you aren't losing because of a lack of effort. Your actual formula is broken.
Welcome to AI market mints.
Turn AI into income. Turn knowledge into freedom. Your digital HQ for smart wealth creation.
Listen, I see people on social media every single day, right? They're wearing their physical exhaustion like it's some sort of, I don't know, elite badge of honor.
Yeah, the hustle culture bragging.
Exactly. They're posting online about pulling these ridiculous 70-hour work weeks. You see the photos of their laptops open at 2 in the morning, just staring at a screen, skipping meals, running entirely on caffeine and pure stress hormones.
It's toxic.
It really is. It is a complete mass delusion of productivity. Hustle culture lied to you on a fundamental mathematical level.
I totally understand the psychology behind it, though. I mean, people generally mean well. They're terrified of falling behind in this economy.
Sure, the fear is real.
Yeah, and they genuinely believe that if they just push their physical limits hard enough, they'll eventually break through some invisible financial ceiling.
But they don't.
No, because the physics of wealth creation, they do not care about your sweat. The core fallacy here is assuming that your physical effort is somehow coupled to your financial scale. It is not.
Right, not at all.
If you are chronically exhausted, you are not moving closer to wealth. You are just operating with extreme inefficiency.
That's the perfect way to phrase it.
Yeah.
You're moving incredibly fast, but you're just moving in a circle.
Exactly.
The sheer volume of kinetic energy you expend has absolutely zero correlation to your actual net worth. Zero. Or your long-term financial security, for that matter.
None.
Listen, obviously, sweat equity is a necessary starting point. When you're 22 and you have, zero capital and zero high-value skills, you have to trade your time.
Right, that's just the initial entry fee to the market.
Exactly. But if you're still trading literal hours for dollars after your first 5 years in the workforce, you are failing at capital accumulation. You're just a very well-paid hamster on a very expensive wheel.
Yeah, and you might even upgrade the wheel, right? Like maybe you get a promotion and it's a mahogany wheel now.
A mahogany wheel, right?
With leather trim.
Exactly. Maybe you lease a nicer car to commute to the wheel, but you are still running just to keep it spinning. Because if we look at the absolute hardest workers in our society, they are almost always fundamentally broke.
Without a doubt.
Let's use a fictional example here.
Mm.
Think about Sarah. So Sarah cleans commercial office buildings at 2 in the morning.
Okay.
Then she pulls a second shift at a mega warehouse fulfillment center. She works significantly harder, like in terms of sheer physical and mental endurance, than a guy like Steve.
Right, Steve being our fictional elite hedge fund manager.
Exactly. Steve is sitting in a temperature-controlled office in Manhattan, clutching a mouse. So the difference between Sarah and Steve clearly isn't their work ethic. It is their systemic leverage.
100%.
Sarah has a leverage ratio of exactly 1 to 1. 1 hour of her physical labor equals 1 fixed unit of pay. That's it.
It's entirely linear.
Right. But Steve has a leverage ratio of like 1 to 10 million.
Right.
1 hour of his strategic decision-making directs capital that works continuously across global markets.
Which is exactly why the modern middle class has been violently sold this toxic myth. We are heavily conditioned to believe that raw effort directly correlates with lasting wealth.
It's everywhere.
But physical effort has a strict biological ceiling. I mean, you cannot work more than 24 hours in a day. It's physically impossible.
Look, I despise the word lazy because people use it to justify, sitting on a couch and expecting the world to just hand them a living.
Right. Nobody's advocating for that.
No. But if we redefine lazy as hyper-efficient capital deployment, then yes, you have to stop grinding. If your income immediately stops the second your hands leave the keyboard, you are in an incredibly vulnerable position.
You're living life on a tightrope without a net.
Exactly. You are one bad flu away from financial ruin.
Or one algorithmic update away. I mean, You are vulnerable to artificial intelligence, to sudden market shifts. If an AI learns to do your primary function tomorrow, your singular source of survival evaporates.
It just disappears overnight.
Yeah. You have to ruthlessly detach your physical labor from your revenue generation. You have to build a machine rather than just being a compliant cog inside of one.
And people don't do it because they are entirely trapped in an outdated paradigm. Yeah. They apply these old industrial era habits to hyper-fast algorithmic markets.
We really need to trace exactly where this mindset came from because honestly, it was not an accident.
No, it's engineered.
The origin of this whole grind set goes straight back to the Industrial Revolution. I mean, before industrialization, human work was largely task-based. It was seasonal.
Right. You harvested the wheat when the wheat was ready.
Exactly. You fixed the barn when the roof leaked. But the factory floor fundamentally changed human conditioning. It required perfect mechanical synchronization.
The assembly line needed everyone there at exactly 8 a.m.
Yeah. The system needed you to punch a physical clock, perform a repetitive physical task, and get paid strictly for the duration of your bodily presence.
They effectively reduced human value to mere physical attendance.
Yes.
The fixed hourly wage and the annual salary, they are primitive artifacts from that exact era. They're compensation models built on the entirely false assumption that economic value is linear.
And think about public schools. They were explicitly designed to produce those compliant factory workers at scale.
Oh, absolutely, the Bell system.
Right. Think about the physical architecture of a traditional classroom from the early 1900s. You sit in straight rows.
Yep.
You do not speak unless spoken to by the manager, I mean the teacher. You follow rigid, standardized instructions.
Don't color outside the lines.
Exactly. And most importantly, you wait for the physical factory bell to tell you when you are allowed to eat, when you can rest, and when you must return to your station.
And that exact blueprint was just seamlessly copy-pasted into the modern corporate office.
Literally, the cubicle farm is just a cleaner version of the textile mill.
But here is the severe mismatch. We are no longer in an industrial economy. We are rapidly accelerating into a ruthless AI-driven leverage economy.
Right.
Yet you have millions of highly educated people out there trying to outgrind machine learning models. It's insane.
It's futile.
You are basically trying to chop down a forest with a hand axe while autonomous machines are rolling in with laser harvesters. You cannot outwork an autonomous software agent.
Wait, Ollie autonomous software agent sounds technical. What does that actually mean for a normal person?
Simple. It just means a piece of code that can make decisions and execute tasks on its own without you pushing buttons. Imagine it like a digital employee that works 24/7, never sleeps, and never asks for a raise.
And that digital employee is continuously iterating and improving at the speed of light.
Exactly.
The historical precedent for this transition is brutal. I mean, whenever deployed capital finds a cheaper, faster way to produce an output, the human laborers attached to the old method are violently marginalized.
It happens every single time.
We saw it with automated looms, we saw it with automotive assembly lines, and we're seeing it right now with cognitive labor.
Let's look at the systemic evidence for this, because the math is undeniable. The entire financial infrastructure of the modern world is explicitly designed to reward capital, not human labor.
It's written right into the law.
Look directly at the tax code. The tax code isn't just a boring set of rules. It is a giant flashing map of societal incentives.
Yeah, it tells you exactly what the government wants you to do.
Right. Income generated from physical work, what the IRS calls ordinary income on a W-2 form, is heavily taxed at the highest possible marginal rates.
The system legally penalizes standard wages.
It destroys them. Look, if you are highly successful at your day job, the government just takes a progressively larger punishing share of your energy.
Yeah, the more you work, the harder you get hit.
You get hit with federal taxes,
Yeah.
then state taxes, then payroll taxes, which are, FICA, Medicare, and Social Security.
Just keep stacking.
By the time that direct deposit actually hits your checking account, you have bled out 30 to 40% of your stored life force before you've even done anything.
Meanwhile, income generated from capital, like long-term capital gains or qualified dividends, receives highly preferential rates.
It's a completely different rule book.
The system explicitly tells you exactly what it values, and it definitively does not value your sweat. I mean, when you hold a productive asset for more than a year and sell it for a profit, the government rewards your capital allocation with a tax rate that is a fraction of what the wage earner pays.
They're actively subsidizing the owners of the economy. The market operates on rules, and those rules are published publicly for anyone to read. If you choose to ignore those rules and keep playing the game using the highest tax strategy available, that is your own failure of adaptation.
Well, I'll push back slightly on that. It's not always a conscious choice to ignore the rules,
Fair enough.
People ignore them because the industrial mindset is so deeply ingrained in our psychology. We are falsely taught that earning money through passive asset growth is somehow less authentic than earning it through sheer physical suffering.
Like it's dirty money if you didn't bleed for it.
Exactly. There is a deeply romanticized narrative around the all-nighter. We inherently distrust wealth that wasn't born from visible exhaustion.
But that is purely a cognitive bias, and it is keeping high achievers poor. Our primate brains demand immediate, tangible rewards over delayed exponential growth.
Yeah, it's hardwired.
Psychologists call it the action bias. We vastly prefer to do something frantic, literally anything, rather than let a quiet system work in the background.
It's the powerful illusion of control. I mean, when you are furiously typing away for 80 hours a week, you falsely feel like you are directly in control of your destiny.
You feel the friction.
Right. You feel the keyboard, you see the emails firing off, you equate that frenetic activity with actual forward progress. It feels safe to be busy because your peers praise busyness.
Everyone pats you on the back for being stressed out.
Let's talk about David. David is a fictional senior software engineer making $250,000 a year.
Okay, David is doing well on paper.
On paper, David is the absolute pinnacle of modern success.
On paper. But let's look at his reality. David ships code late at night. He is chronically exhausted. He lives on a strict diet of caffeine and the validation he gets from his massive W-2. He genuinely thinks he is winning.
But David is trapped in a golden cage. His elevated lifestyle demands that massive cash flow.
Right, he's got the overhead.
He has a suburban mortgage, luxury car leases, private school tuition for his kids. His monthly burn rate is terrifyingly high. He has a high income, but zero actual leverage and zero discretionary time.
None.
If he misses 2 paychecks, the entire facade crumbles. He is completely bankrupt in terms of autonomy.
If David stops coding tomorrow, the money stops flowing immediately. He is renting his lifestyle from his employer on a month-to-month basis. And here's his fatal flaw.
What does he do?
David feels the burnout. So he decides to start a development agency to, quote-unquote, scale his efforts.
Oh, no.
Right? He hires 3 junior developers. He genuinely thinks he is building leverage. But all he did was build himself a much harder job.
He fell entirely victim to the more is better fallacy.
Exactly. Instead of just worrying about his own code, he is now micromanaging 3 juniors who write subpar code.
So now he's a manager and a coder.
Yep. He is putting out client fires at midnight.
Yeah.
He is stressing over payroll taxes. He lacks the psychological discipline to step away from the daily operations.
Because he's an engineer, not a capital allocator.
He doesn't know how to allocate capital. He only knows how to allocate his own finite time. He views his employees as extensions of his own hands.
Because for high achievers like David, letting go of control is an acute psychological discomfort.
It's agonizing for them.
They have to violently let go of the ego boost that comes from being the hardest worker in the room. You have to be okay with someone else or an automated system executing a task at 80% of your perfection level.
Right.
Because freeing up your time is mathematically more valuable than that missing 20%.
Busy is the new stupid. I will say it again. Busy is the new stupid.
I love that.
If your calendar is packed back to back with 0 white space, you leave absolutely no room for high-level strategy. You cannot spot rare market openings if you are playing whack-a-mole with incoming emails all day.
You're just reactive.
You miss asymmetrical opportunities entirely.
Wait, Ollie, asymmetrical opportunities sounds technical. What does that actually mean for a normal person?
Simple. It just means a bet where the potential upside is massive, but the potential downside is strictly capped. Imagine it like buying a lottery ticket where you only risk $1, but you could win $1 million, except based on math, not luck.
And David never sees those rare opportunities because his head is permanently down.
Exactly.
He is blinded by his own kinetic energy. When a massive technological shift happens, David misses it entirely because he was too busy debugging a legacy software module.
Let's strip away the psychology entirely for a second. I want to look at the brutal, undeniable math where the grind set mathematically collapses.
Let's do it.
We have to break down the silent wealth killers, which are taxes and inflation. These are the engines of destruction.
And they operate silently. I mean, you bleed capital before you even pay your rent.
Let's run the exact numbers on this.
Yeah.
You grind to earn a $100,000 salary. The government immediately takes 30% off the top.
Right.
So you are left with $70,000. You haven't bought a cup of coffee, and you have already lost nearly a third of your output.
It hurts just thinking about it.
Then, inflation at 5% aggressively destroys the purchasing power of that remaining 70 grand. The numbers in your bank account stay the same, but the amount of housing and food those numbers can buy decreases.
It shrinks every day.
You only experience the true utility of maybe $65,000.
Which brings us to opportunity cost. When you trade your time directly for money, Your cost of capital is effectively infinite
Infinite.
because your human time is strictly finite. You only possess 24 hours in a day. Any economic model relying on scaling your hours hits a hard biological ceiling.
Let's compare two people. We'll look at fictional worker A and investor B.
Okay.
Worker A decides to fully embrace the grind set. He takes on a second job. He works every single weekend, adding 1,000 hours a year to his schedule for a $20,000 side hustle.
On the surface, he feels highly productive.
Extremely. But look at the marginal tax rates. That extra $20,000 is stacked directly on top of his primary salary. He is paying his highest possible tax bracket on that money.
Right, because it's the last dollars earned.
After federal taxes, state taxes, and FICA, that 20 grand is quickly knocked down to $12,000 net. He worked 1,000 extra hours for 12 grand.
That is an abysmal $12 an hour of actual net benefit for sacrificing his life, his weekends, his health.
Exactly.
He stops working out, his stress explodes, his relationships suffer, all for a net gain that barely moves the needle.
Now look at investor B. She refuses to grind.
Okay.
She deploys $50,000 of saved capital into a broadly diversified index fund and a dividend portfolio automatically yielding 8% annually.
She sets up the parameters and just walks away.
Yep. Year one, that $50,000 generates $4,000. She did 0 hours of physical work for it.
And because it is classified as long-term capital gains or qualified dividends, the tax burden is drastically minimized.
Almost nothing compared to worker A. But year two is where the math really destroys the grind set.
Because of the compounding.
Right. She doesn't start from zero. She automatically earns 8% on $54,000. The compounding effect begins. By year 10, that initial capital has more than doubled without her lifting a single finger.
Wow.
Worker A is still miserably grinding on weekends 10 years later, while his hourly rate is stagnant because inflation ate all of his marginal raises.
Wait, Ollie yield on energy sounds technical. What does that actually mean for a normal person?
Simple. It just means measuring how much ongoing money you get from a one-time burst of effort. Imagine it like planting an apple tree once versus having to buy apples at the store every single week.
Investor B planted the apple tree.
Exactly.
Worker A is just running to the store over and over, ignoring the fact that the store owner is getting rich off his repeated trips.
And what does the average middle-class worker do when they actually get a surplus? Let's say they get lucky.
They usually blow it.
They take their year-end bonus, which, remember, represents hundreds of hours of stored labor, and they immediately buy a rapidly depreciating asset like a luxury car.
Oh, the car trap.
They sign a lease on a $60,000 vehicle that loses 20% of its value the absolute second the tires touch the road.
It's painful to watch.
They are literally taking thousands of hours of their stored life and setting it on fire just to signal success to other broke people.
Getting this math wrong isn't just a minor mistake. It has catastrophic consequences over the next decade. We really have to project the listener's life 10 years into the future based on these two distinct paths.
Let's run the simulation. Path 1 is the grind set.
Okay, path 1. You keep your head down. In 10 years, advanced multimodal AI completely commoditizes your specific technical skills.
It's already happening.
The cognitive tasks you perform manually right now will be executed flawlessly by AI models at a fraction of a cent.
Your active income will drop drastically. Your stress will peak because you are suddenly in a terrifying race to the bottom against algorithms that do not demand health insurance, they don't take vacations, and they do not need sleep.
You will reach your 50s completely burned out. You'll be underfunded because you prioritized depreciating lifestyle assets over compounding systems.
Right, a car instead of the portfolio.
The system will view you merely as an expensive legacy cost. You become a liability on a corporate balance sheet that they are actively trying to engineer away.
Now look at path 2, the anti-grind set.
Path 2, you spend the next 10 years acquiring productive assets and leveraging AI to build a profitable micro business.
Yep.
In 10 years, you are entirely decoupled from the labor market. If an advanced AI model completely replaces a skill you used to have, it doesn't matter at all because capital pays your bills.
You own shares in the companies building the AI. You profit from the exact same automation that is destroying the wage earners.
You have total autonomy. I mean, waking up on a random Tuesday knowing your financial survival doesn't depend on your physical presence at a desk or the whims of a middle manager.
That's the ultimate goal.
The middle ground is disappearing. Historically, you could be a median performer in a corporate job and expect a safe retirement. That reality is completely dead.
You either own the systems or you get consumed by them. There is no alternative. So how exactly do we build this infrastructure today? It requires a strategic solution.
Step one is the audit. You must stop identifying as a worker. You have to view yourself as the CEO of your personal holding company.
Right, a complete identity shift.
You must fire yourself from low-leverage tasks. If you can outsource a task or use an AI tool for less than your target hourly rate, you do it instantly.
If your target rate is $200 an hour and you are sitting 3 hours on a Saturday mowing your lawn to save $40, you are actively destroying your own wealth.
I wouldn't say they are destroying it intentionally. I mean, they just think they're being financially responsible by saving cash.
Sure, they think they're being frugal.
But they are failing to value their pristine mental bandwidth. You cannot spot those asymmetrical opportunities if your brain is cluttered with low-level administrative garbage.
Step 2 is emotionless automation. Listen to me very carefully on this. Personal discipline is a highly depleting resource.
It absolutely is.
It fluctuates with your sleep, your stress, your diet. If you manually transfer your investment money every month, you will inevitably sabotage yourself.
Human nature gets in the way.
You will see a market drop and get scared. Your car will need new tires. You will feel you somehow deserve a vacation. Money must automatically leave your operating account before you even realize it exists.
Which leads right to step 3, which is the architecture. We strictly advocate for a pie-based approach to investing.
Yes, the pie model.
You clearly define your long-term target percentages once. For example, 40% in a broad S&P 500 ETF to capture general economic growth.
Solid foundation.
20% in dividend aristocrats for consistent cash flow. 20% in tech growth. And 20% in short-term treasuries as a stabilizing ballast against volatility. You define the blueprint exactly once.
But to execute that without failing, you need a centralized, intelligent system to handle this complex routing without manual spreadsheets. You cannot do this by logging into a basic brokerage and trying to do the math on a Sunday night.
This is where M1 Finance operates as the core engine of this strategy. It flawlessly handles the granular execution.
It's the infrastructure.
It automatically calculates fractional shares, meaning every single cent of your recurring deposit is instantly deployed according to your exact pie percentages.
And it dynamically rebalances your portfolio automatically. If your tech stocks drop and become underweight, the algorithm routes your next deposit specifically to buy those tech stocks at a discount.
So it forces you to do the right thing.
It forces you to buy low without you ever having to analyze a chart or fight your own emotional fear. And it does this without wealth-destroying management fees.
Set up your pies, turn on auto invest, and confidently step away from the daily ticker tape. Let the algorithm maintain your exact risk profile.
We've put the official verified links in the pinned comment below. Don't go searching randomly and get scammed. Use the ones we've checked.
Stop grinding yourself to dust. Start building the machine that will generate autonomous leverage in the background while you actually live your life.
Don't let the future leave you behind. Start earning.